Throughout modern financial history, silver has never moved quietly. It's always been the wild child of precious metals. Unlike gold, which is carefully managed and hoarded by central banks, silver lives a much more turbulent life. It's caught right in the middle of heavy industry, frenzied speculation, and our deep-seated monetary psychology. When silver crashes, it's not just a bad day for metals traders. It's a signal, a tremor that exposes hidden stress fractures throughout the entire global financial system. And right now, some analysts are seeing familiar, unsettling signs. They're quietly pointing to patterns that mirror past silver collapses. We're talking about tightening liquidity, rising real interest rates, and gloomy forecasts for industrial demand. On top of that, we're seeing extremely heavy speculative positioning in the market. Now, let me be clear, none of this is a crystal ball. It doesn't guarantee a crash. But history has a powerful way of rhyming, and when these specific conditions align, silver has a nasty habit of falling much faster and much deeper than most investors are ever prepared for. So what makes silver so volatile? Why is it so different from its calmer, more respected cousin, gold? The secret lies in its dual personality. Silver behaves like two completely different assets trapped in one shiny package. About half of its value is tied directly to industrial demand. Think about it, silver is essential for electronics, solar panels, and a whole range of medical equipment. It's a workhorse metal. But the other half of its value comes from its age-old role as a psychological safe haven, a hedge against currency, debasement, and instability. It's what people turn to when they lose faith in paper money. And this is where the trouble starts. When economic growth starts to slow down, but at the same time, central banks tighten monetary policy to fight inflation, silver gets hit with a devastating 1-2 punch. Industrial demand falls, and the appeal of holding a non-yielding asset like silver also diminishes. It gets squeezed from both sides simultaneously, and the price can plummet. This isn't just a theory. We've seen it play out repeatedly. Look at the major silver downturns of the past. Think about the early 1980s, the late 1990s, and the brutal bear market from 2011 to 2015. These collapses were not random acts of market chaos. They followed a predictable, almost scripted pattern. First, you get a period of wild speculative excess. Everyone piles in, convinced silver is going to the moon. Then, financial conditions start to tighten. Interest rates rise, and money becomes more expensive. This leads to the final stage, forced selling. The very same speculators who piled in on leverage are now forced to sell at any price to cover their debts. It's a classic story where retail investors, often drawn in by the hype, usually arrive late to the party and are left holding the bag, while the smarter, institutional players have already quietly exited stage left. They saw the writing on the wall and got out before the panic set in. But here's the most important part, the part that most people completely misunderstand. Real, generational wealth is rarely created during the crash itself. The crash is just the chaotic, destructive phase. The true opportunity arises in the aftermath, after the panic has subsided. Wealth shifts happen when assets are repriced to more realistic levels, when all the dangerous leverage has been flushed out of the system, and when the true, long-term value becomes visible again to those who are willing to look. The people who truly benefit from these cycles are not the ones reacting emotionally to the scary headlines. They're not the ones panic selling at the bottom or panic buying at the top. The winners are the ones who understand the cyclical nature of markets. They've studied the patterns, and they have a plan. A silver crash doesn't mean the metal suddenly becomes worthless. Far from it. What it really means is a massive transfer of ownership. Ownership moves from the weak, over-leveraged hands of short-term speculators to the strong, patient hands of long-term capital. It means the economics of silver mining get a complete reset. High-cost mines might shut down, reducing supply and setting the stage for the next price recovery. It means industrial users, the companies that actually need silver to make their products, suddenly gain immense pricing power. And it means the popular narrative, the story of silver scarcity that drove the speculative bubble, temporarily collapses before it inevitably begins to rebuild itself for the next cycle. You might think that governments and big financial institutions would fear a commodity crash, but in reality, they often secretly welcome them. Why? Because lower input prices for things like silver help to suppress overall inflation, they can help stabilize currencies, and, most importantly, they give policymakers valuable breathing room. It takes the pressure off. That's why these events are rarely framed as the systemic warnings they truly are. Instead, they're publicly dismissed as simple market corrections, a healthy cleansing of excess. This happens even when trillions of dollars in paper value evaporate, causing immense pain for millions of ordinary investors. The system protects itself, and a commodity crash can be a useful pressure release valve. So, if history is any guide, a major silver drawdown, should it happen, wouldn't be the end of the metal's story. It wouldn't mean silver has lost its relevance. It would simply be a reset of expectations, a brutal but necessary clearing of the speculative froth. Think about it. Every single major silver collapse in history has eventually been followed by a powerful, structural rebound, but that rebound only happens after the excess speculation has been completely purged from the system and the market narratives have been reset. The hype has to die down before a healthy foundation can be rebuilt. It's a cycle of boom, bust, and rebirth that has repeated for centuries. Ultimately, the real lesson here isn't just about silver. This is much bigger than one single commodity. It's about understanding the fundamental way financial cycles work. It's about how they reward patience, meticulous preparation, and, above all, emotional discipline. Markets are designed to be a mechanism for transferring wealth, but they don't do it loudly with bells and whistles. The transfer is silent and subtle. Wealth quietly moves from those who chase exciting narratives and get-rich-quick stories to those who patiently wait for the system to reset. It's a transfer from the emotional reactor to the disciplined strategist. This video is not a prediction. I don't have a crystal ball for 2026 or any other year. It is simply pattern recognition. It's about looking at the history of this unique and volatile asset and understanding the lessons it has taught us over and over again. And every time silver has collapsed in the past, it has hammered home the exact same lesson. Panic creates opportunity, but that opportunity is only available to those who understand the cycle, not to those who are simply reacting to the fear-mongering headlines of the day. The question you have to ask yourself is, which one will you be? Thank you for watching. If you found this analysis valuable, please like this video, subscribe to the channel, and hit the notification bell so you don't miss our next deep dive. See you next time.